Let's face it, you wouldn't plant a seed and then dig it up every week to see if it's grown, would you? Investing is the same. Just like a tree needs time to grow, your investments need time to mature and flourish. Patience is key. The earlier you plant your money seeds, the more time they have to blossom into a financial oak tree. Imagine the potential growth over decades, not just years. The power of compounding interest can turn small, consistent investments into substantial wealth. Time is your secret weapon. It's the silent force that works in the background, turning your financial dreams into reality. The longer you stay invested, the more you benefit from the market's natural growth. It's not about timing the market, but time in the market. Trying to predict market highs and lows can be stressful and often counterproductive. Instead, focus on staying invested and letting time do the heavy lifting. Starting early lets the magic of compounding work wonders. Compounding is like a snowball effect. The earlier you start, the bigger the snowball gets as it rolls down the hill, accumulating more snow along the way. Remember, even small amounts, consistently invested, can grow exponentially over time. You've got this. Every dollar you invest today is a step towards financial freedom. Consistency and discipline are your best friends in this journey. Think of it like this. You're 20 today. Imagine the financial security you could have by the time you're 50 if you start now. The earlier you start, the more you can take advantage of the time. Putting aside just $1,000 a month can potentially turn into over $2 million by the time you hit 50. This isn't magic, it's the power of consistent investing and the passage of time. That's the power of starting early. The earlier you begin, the more time your money has to grow and multiply. It's a simple yet powerful concept. It's not about being rich now, it's about laying the groundwork for a prosperous future. Your future self will thank you for the decisions you make today. It's about making smart choices today for a wealthier tomorrow. Every step you take now is an investment in your future. So start today, stay consistent, and watch your financial dreams come true. Ever heard the saying, don't put all your eggs in one basket? Same goes for investing. ETFs, or exchange-traded funds, are like baskets of stocks. They let you invest in a variety of companies with just one purchase. This spreads your risk and increases your potential for growth. Think of it like a buffet for your portfolio. You get a taste of everything instead of loading up on just one dish. Diversification is key. It cushions your portfolio against market swings because all your eggs aren't in one basket. ETFs make diversification easy and accessible. There are ETFs for almost every sector imaginable: technology, healthcare, energy, you name it. This gives you the power to tailor your investments to your financial goals. Now let's talk about three powerful ETFs: VGT, VUG, and VEO. These ETFs are designed to help you grow your investments by focusing on different sectors and strategies. These bad boys are your engines for growth. They each have unique characteristics that can help you achieve your financial goals. VGT, or Vanguard Information Technology ETF, focuses on the technology sector, a high-growth area with companies constantly innovating. This ETF includes giants in the tech industry, making it a great choice for those looking to capitalize on technological advancements. Think Apple, Microsoft, and Tesla. These companies are at the forefront of innovation and have a significant impact on the tech landscape. VUG, or Vanguard Growth ETF, targets companies with above-average growth potential across various sectors, from healthcare to consumer discretionary. This ETF is ideal for investors looking for diversified growth opportunities. VOO, or Vanguard S&P 500 ETF, tracks the S&P 500 index, representing 500 of the largest U.S. companies, providing broad market exposure. This ETF is a staple for many investors due to its stability and comprehensive market coverage. Each ETF plays a crucial role in our strategy. By combining these ETFs, you can create a balanced portfolio that leverages growth, innovation, and stability. VGT provides targeted exposure to the booming tech industry. It's perfect for those who believe in the long-term potential of technology. VUG offers diversified growth potential. It includes companies from various sectors, ensuring that your investments are not tied to the performance of a single industry. VEO acts as a stable anchor, reflecting the overall market's performance. It's a great way to gain exposure to the broader market without taking on too much risk. Remember, these are just examples. Always do your own research or consult with a financial advisor before making investment decisions. Investing in ETFs can be a powerful way to grow your wealth, but it's important to understand the risks and rewards associated with each option. We're aiming for aggressive growth, right? So let's allocate our $1,000 monthly investment strategically, 50% to VGT. We're betting big on technology, a sector poised for continued innovation and growth. 30% to VUG, diversifying our growth potential by tapping into various sectors with promising companies. 20% to VOO, providing a solid foundation with exposure to the overall U.S. market. This allocation balances focused growth with diversification. It's like having a well-rounded team, each player contributing to the win. This strategy isn't set in stone. As you gain experience and your risk tolerance evolves, you can adjust the allocation to align with your financial goals. Remember, diversification is key to mitigating risk. By spreading your investments, you're less likely to be affected by a downturn in any single sector. Let's talk numbers. Assuming an average annual return of 8%, which is a reasonable expectation for long-term market growth, here's how your $1,000 monthly investment could grow over 30 years. This is not just a theoretical exercise. It's a practical demonstration of how powerful compounding can be when you commit to a consistent investment strategy. Year 1, $12,000 from your contributions, plus $960 from an 8% return, totaling $12,960. It might not seem like much at first, but remember, this is just the beginning. The magic of compounding starts to show its true colors as time progresses. By year 5, your investment could grow to around $78,000. This includes your $60,000 in contributions and the additional growth from the returns on those contributions. The snowball effect is starting to take shape. By year 10, it could reach around $183,000. At this point, your contributions total $120,000, but the power of compounding has added an impressive $63,000 in returns. By year 20, you might see it grow to around $590,000. Your contributions are now $240,000, but the returns have more than doubled your investment. This is where the exponential growth of compounding really starts to become evident. And by year 30, your investment could be worth over $2.15 million. Your total contributions would be $360,000, but the returns have skyrocketed, making up the majority of your investment's value. This is the power of compounding. Your money earns returns, and those returns generate their own returns, creating a snowball effect. The longer you let your money work for you, the more pronounced this effect becomes. It's like planting a tree. The longer it grows, the more fruit it bears. Remember, past performance doesn't guarantee future returns. However, history shows that the stock market tends to grow over the long term. It's important to stay informed and be aware of market trends, but also to remain patient and committed to your investment strategy. By investing consistently and letting your money compound, you're harnessing the incredible power of time to build wealth. It's not about timing the market, but about time in the market. The earlier you start, the more you can benefit from the magic of compounding. So start today and let your money grow. The market goes up, the market goes down. It's like a roller coaster ride. But don't worry, you're strapped in with a strategy called dollar cost averaging. Instead of trying to time the market, which is nearly impossible, you invest a fixed amount at regular intervals, regardless of the market's ups and downs. Here's how it works. When prices are low, your fixed amount buys you more shares. When prices are high, you buy fewer shares. Over time, this strategy averages out your purchase price, potentially reducing your overall cost and boosting your returns. Remember, dollar cost averaging doesn't guarantee profits or eliminate risk. However, it's a disciplined approach that can take the emotion out of investing and help you stay on track. You might be thinking, wait, don't these ETFs overlap? Why invest in VGT and VUG when they both hold tech companies? That's right, there's some overlap. But here's the thing, it's intentional and beneficial. Think of it as doubling down on your winners. The tech sector is a powerhouse of growth, and we want to maximize our exposure to it. VGT provides focused tech exposure, while VUG offers diversified growth with a tech tilt. This overlap amplifies our potential returns from the thriving tech industry. It's like having multiple streams of income from a single source. Remember, diversification is still essential. VOO provides exposure to other sectors, ensuring we're not overly reliant on any single industry. Remember our winning formula? 50% VGT, 30% VUG, 20% VOO. Over time, these percentages might drift as market values fluctuate. That's where rebalancing comes in. It's like giving your portfolio a tune-up. You're realigning your investments to match your original allocation. For example, if tech stocks skyrocket and VGT grows to 60% of your portfolio, you'd sell some VGT and buy more VUG or VOO to bring it back to 50%. Rebalancing helps you maintain your desired risk level and might even boost your returns by forcing you to buy low and sell high. Remember, rebalancing should be done periodically, perhaps annually or semi-annually, not in reaction to short-term market swings. Let's talk taxes. Nobody likes them, but they're part of the game. The good news is, you can be smart about minimizing your tax burden. Consider investing in tax-advantaged accounts like a Roth IRA. These accounts allow your investments to grow tax-free, meaning you won't owe taxes on your earnings when you withdraw in retirement. Another strategy is to hold your investments for longer than a year. This qualifies you for lower long-term capital gains tax rates, potentially saving you a significant amount of money come tax time. Remember, tax laws can be complex and vary depending on your individual circumstances. It's always wise to consult with a qualified tax advisor for personalized advice. Congratulations! You've just taken a crash course in building a $2.15 million portfolio. Remember, investing is a marathon, not a sprint. There will be ups and downs in the market. Tune out the noise and stay focused on your long-term goals. Stay disciplined with your monthly contributions. Embrace dollar-cost averaging. Rebalance periodically. And remember, knowledge is power. Keep learning and evolving your investment strategy. You've got the tools and the mindset to achieve financial freedom. Now go make it happen.